By the end of the late 1990s, investors had become, well, over-infatuated with the ability of the internet to market anything. So they began to look at offerings for companies like the famous Pets.com, which went public at $1 billion based on investor belief that you could market puppies and kittens by the internet better than through the pet shop.
This is Mac William Bishop for DealBook at the New York Times. As multi-billion-dollar valuations for marquee name social media companies become the norm, echoes of the dot-com boom and subsequent bust reverberate among investors. While it is too soon to say when and if the social media bubble might burst, there are important structural differences between the enthusiasm for social media today and yesterday's irrational exuberance for dot-coms.
This time around, the bubble, if it is already a bubble, that is occurring is one where the companies themselves are getting some money, but most of the transactions that we read about or hear about are ones that are done by private shareholders to private investors.
High-profile brands like Facebook have been receiving valuations as high as $75 billion. However, few of the social media companies that are attracting the attention of institutional investors have made their numbers public. So these valuations are being analyzed largely on the basis of private transactions made on secondary markets.
Officers, directors, shareholders who had shares needed to liquidate some of their investments because of the financial crisis, and they turned to some of these brokers who got into the business of finding secondary sales under which an insider could sell some of his shares to a sophisticated investor. Based on that, we've seen some valuations placed on these companies, but these are valuations based on selling only 1%, 2%, or 3% of the company's stock.
The danger inherent in any stock bubble is that, in the fear to get a piece of the next big thing, investors may put a premium on unsound investments. Separating the wheat from the chaff becomes more difficult.
What happens at the end of one of these cycles is we start taking anything that investors might look at because investors are so hungry for the quick run-up in price on the first day that they also begin to lose any serious scrutiny of what's actually being sold to them.
But the fact that investment in the social media boom is taking place largely through private transactions on secondary markets may limit the damage should the bubble burst.
Nobody knows where we are in the cycle in terms of the social networking bubble. It could be early, middle, or late, but when it's over, it's over. At this point, it would not appear that there are a lot of individuals involved in it, which is a good thing if it's a bubble.
That may change amid a flurry of upcoming IPOs by companies such as LinkedIn, Groupon, and Facebook. This is Mac William Bishop for DealBook at the New York Times.